Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at strategy.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay.
With strategy, you have this fascinating duality. On one hand, you have a software intelligence company with, frankly, untouchable fundamentals.
A real fortress.
Exactly. But on the other hand, you have this highly complex, very aggressively managed capital structure. So the mission today is to figure out, which story should really be guiding your decision.
That's the perfect way to frame it. Because if you just look at the raw numbers, the profitability, it paints a picture of, well, almost invincibility.
It really does. I mean, let's start with the bedrock. The margins. Strategy has a gross margin of 70.12%.
Which is just, it's extraordinary.
It is. Very few companies, outside of the absolute biggest tech giants can sustain anything like that.
Yeah.
It speaks to a massive structural advantage.
Pricing power.
Huge pricing power and incredibly low costs for their core product. And that margin power, it flows directly to the bottom line.
Which is why the valuation is so interesting. They've got a trailing 12-month net income of, what, $7.72 billion?
That's right. And yet the PE ratio is sitting at a surprisingly low 6.24.
So the market is either skeptical that those earnings can last, or it's just plain undervalued.
And those profits aren't an accident. They come from just superior operational efficiency. We look at the return metrics. ROE is at 25.59% and ROA at 16.75%.
These aren't just good numbers. They are exceptional. It shows they are squeezing returns from every single dollar of assets.
Maximizing output, minimizing resources.
The number that really stands out to me, though, as part of their technological moat, is the profitability per employee. $5.03 million.
It's a staggering number.
It's the clearest signal that they are leveraging AI and analytics to scale without having to hire, linearly. It's the software dream, really.
But that figure also brings up a key question, doesn't it?
Yeah.
A vulnerability.
I was just about to ask, if you're relying on such a small, specialized team to generate $5 million per head, what happens if a few key people leave?
That's the risk. The moat seems very deep, but maybe also very narrow. A couple of key departures from that core AI team could have a huge impact on their innovation pipeline.
It's a strategic vulnerability, for sure.
For now, though, that operational cash generation is what's allowing them to play this aggressive capital game we're seeing.
And that sophisticated financing game is really the defining story for the stock over the past year. It's almost a masterclass in aggressive capital allocation.
They've tapped the institutional markets again and again, very successfully, especially for preferred equity.
We saw that huge demand from institutional players, right? They raised $2.521 billion back in July.
They did. And they didn't stop there. Just this past November, they tapped the European market for another $620 million. They're clearly going after deep pockets of capital.
But it's not just the amount of money they're raising that's interesting. It's the framework they've built to manage issuing their common stock.
Yes.
Management has tied it to this MNAV, or modified net asset value, multiple. Can you really unpack that for us? Because that's where the real sophistication is.
Certainly. The MNAV framework is basically management telling the market, we are disciplined. They've publicly said they will only issue Class A common stock when their own internal valuation metric, that MNAV multiple, falls below 2.5 times.
Okay, but hang on. How do we trust an internal, self-serving metric? Isn't that just giving themselves cover to issue shares whenever they need cash?
That's the healthy skepticism you should have. But by putting that 2.5x number out there publicly, they create a kind of self-regulation. If they break that promise, the market will punish them.
So it's designed to assure shareholders they're only issuing equity when they think the market is getting it wrong.
Exactly. When they see an arbitrage opportunity for the firm, not when they're desperate for cash.
It's a transparency tool then, forcing them to be disciplined. And speaking of confidence, they even bumped the dividend on their STRC preferred stock series, right? From 10.25% to 10.50%.
They did, which signals they're very confident in their ability to service these high-yield debts. It tells you the cash generation is strong enough to handle it.
But that brings up another point. Why so many different classes of preferred shares? We've got STRC, STRE, STRK, all in the last 6 months. What's the strategy there?
That's a great question. It's all about targeting. The differences are likely about attracting very specific types of institutional buyers.
So different tranches for different appetites?
Precisely. By tweaking the terms, different yields, different call dates, even different currencies like that euro deal, They can target, say, a sovereign wealth fund that has totally different needs than a domestic pension fund.
So it's a bespoke issuance strategy.
It allows them to raise the maximum amount of capital at the lowest possible overall cost.
But all of this aggressive innovation, that's where the risk comes in. We have to talk about the bear case, starting with liquidity.
Yes. The short-term ratios look constrained. The quick ratio is 0.52, current ratio at 0.66.
In a normal company, those would be huge red flags. It suggests they can't cover their short-term bills.
It would. But this is where we have to go back to their business model.
Right. So given their margins and software models, is this them being strategically lean, knowing cash comes in fast, or is it a genuine, operational risk?
I think we have to treat it as a risk that needs monitoring.
Yeah.
Yes, they are a cash generation machine. We talked about the $7.72 billion in net income, but an unexpected market freeze could expose them. It's mitigated, but the ratios are objectively tight.
And the other massive risk is dilution. We talked about the MNAV framework for common shares, but what about the preferreds? They massively increased the authorization for the SDRK series.
From 7.3 million shares to nearly 270 million, a 40-fold increase in what they could issue.
That is just staggering capacity.
And while they haven't issued all of them, the potential is there. If market conditions sour and they have to issue preferreds at even higher yields, it could start to really eat into the net income that's available for common shareholders.
And let's not forget the market dynamics. This is not a set it and forget it stock. It has a beta of 3.37.
That number needs to be translated. A beta like that means if the S&P 500 drops 1%, this stock is statistically likely to drop over 3%.
So you're signing up for a wild ride.
Absolutely. The swings can be very lucrative on the way up, but they are brutal on the downside. It demands active management.
And finally, the insider sales. We saw the EVP and General Counsel selling in November. That always spooks people.
It does, but the context here is critical. The sales were part of a prearranged plan tied to that executive's planned retirement on December 31st.
So it's a structured exit, not a sign of panic.
It looks that way.
Still, the optics of selling right before this big reserve fund deployment is announced, it raises questions. Doesn't it sort of suggest the executive thinks the stock is at a local peak?
It certainly creates bad optics, and that can cause short-term volatility. But the retirement itself is a transition point, which leads us right into the huge near-term catalysts we're expecting.
The biggest one, of course, is the $1.44 billion reserve fund they announced in November. What they do with this cash is going to define the story for the first half of next year.
Absolutely. This is the inflection point. They've been vague, which creates ambiguity and opportunity. There are three likely paths.
M&A, strategic investment, or a short buyback.
Exactly. A big M&A deal to buy a competitor, an investment to double down on their tech, or the one that gets shareholders most excited, an accelerated buyback.
And that choice is a huge strategic signal. A buyback is a short-term sugar rush. It would immediately compress that low PE.
While M&A would signal a commitment to long-term structural growth, validating that tech moat they claim to have.
The executive transition is also a catalyst. With the general counsel leaving, who fills that void?
And the rumors are that the new leadership will be heavy on capital markets expertise, a sign that this financing strategy is now core to who they are.
Okay, so let's put some dates on the calendar for people. The Q4 earnings release, that's expected January or early February.
And that's critical. That's where we'll likely get the guidance and maybe, just maybe, the announcement on how that $1.44 billion reserve gets used.
We also have to think about institutional flow. All these new preferred shares mean ETF rebalancing, and big fund filings are due in January and February.
Which can drive huge sudden inflows or outflows of cash, amplifying that volatility we already talked about with the high beta.
And right at the end of the year, December 31st, the first dividend on the new STRE preferreds is due. That's a key liquidity test.
So with that backdrop, solid fundamentals, an active capital strategy, and all these catalysts lining up, the technicals should look pretty good.
And they do. The stock is trading comfortably above both its 50-day and 200-day moving averages, a textbook uptrend.
We're also seeing that the market is willing to buy the dips. Since that volatility spike in July, the price has been making consistent higher lows. That's a sign of underlying support.
Looking at a trading range, support seems to be holding around that $170 to $180 level. That's the floor.
And on the upside, the near-term breakout target is around $310. If the reserve deployment news is good, well, some analysts see long-term targets stretching as high as $705.
Which is massive potential upside. But it all hinges on them executing this complex financial strategy perfectly.
The takeaway is that strategy is one of the simplest and, at the same time, one of the most complex stocks out there.
Simple because the core business is a cash machine.
But complex because of how they're using leverage and all these sophisticated financial tools. It creates huge opportunity, but also huge risk.
So you have to decide which story you believe in, the short-term volatility or the long-term structural growth story.
And the entire thesis really hangs on one single question now.
The $1.44 billion reserve.
Exactly. Will management go for the short-term sugar rush of a buyback? Or will they pursue a transformative acquisition that could actually justify that long-term $705 target?
That's the strategic choice that will dictate everything.
It's the ultimate inflection point we're watching. Thank you for joining us for this analysis of strategy. If you found our talk insightful, remember to subscribe and hit that like button. We'll be tracking Strategy's next moves right here.